Welcome to the deep dive. Today, we're jumping headfirst into the really fast-paced world of foreign exchange. If you've ever wondered what moves all that money around the globe every day, trillions of dollars, well, you're in the right place. It impacts everything. We're going to unpack a specific document today. It's a Forex market analysis and forecast, focusing particularly on the next 24 hours in the U.S. session. It's quite layered, pulling together economics, chart patterns, even market mood. So our mission really is to figure out how are these big central bank meetings, geopolitical shifts, and key data points going to shape currencies right now? And, why should you care? Why is understanding this important?
That's a great question because we really are at a critical point. A lot of the immediate action is driven by this, well, risk-on feeling in the markets. Investors are feeling a bit more optimistic, maybe willing to take more risks.
Okay.
And that's largely down to reports, hints really, of potential de-escalation over in the Middle East. This optimism, it's pushing back against safe havens like the U.S. dollar. And this is crucial, it's really fragile, this feeling.
Yeah.
It's based on signals, not, concrete facts on the ground. It could flip very, very quickly.
Okay, that fragility is key then. So digging into the analysis, one big theme is this great monetary policy divergence. Sounds significant. What exactly does that mean for currencies?
It means central banks are basically singing from different song sheets. And yeah, it's probably the biggest driver right now. You've got these major players charting really different courses.
Okay, like who?
Well, let's start with the Federal Reserve, the Fed.
Mm-hmm.
Everyone expects them to keep their main rate steady at 4.50% in the upcoming meeting.
Right, holding steady.
So the real focus shifts to what they say about the future. Their forward guidance. We'll be watching the FOMC statement, the updated economic projections, the dot plot where they map out rate expectations.
The dot plot.
And, of course, Chair Powell's press conference afterwards.
It's tricky because recent data is, well, conflicting. Inflation looks a bit softer, but the Fed previously hinted at just one rate cut this year.
So, uncertainty there. Exactly. It creates what the analysis calls an asymmetric risk profile for the dollar. If the Fed sounds more dovish, hints at cuts coming sooner, the dollar probably keeps weakening.
Okay.
But if they pull a hawkish hold, really emphasize fighting inflation, maybe hint at higher for longer rates, that's a surprise scenario. That could spark a really sharp dollar rally as people betting against it scramble to cover.
A surprise rally. Okay,
Right.
What about Europe?
Well, the European Central Bank, the ECB, they already moved, cut their main rate by 25 basis points down to 2.15% back on June 5th.
I went ahead and cut.
Yeah, citing risks of inflation actually falling below target. They're now projecting inflation hitting 2.0% in 2025. So that's a clear, proactive, dovish pivot. And that sets up this fundamental policy divergence with the Fed. Long term, that's fundamentally bearish for the euro against the dollar for USD.
Makes sense. Diverging paths. In Japan, the Bank of Japan.
Right, the Bank of Japan, the BOJ, they're expected to hold their rate at 0.50%. The big question mark there is their plan for tapering, reducing their huge Japanese government bond, or JGB purchases.
Why does that matter so much?
It directly impacts the JPY-funded carry trade. The really popular strategy, investors borrow yen at super low Japanese rates, then invest it in places with higher yields, like the U.S. or Australia.
Ah, the carry trade. Borrow cheap, invest high.
Exactly. And the BOJ buying bonds keeps those Japanese yields low, making the trade profitable. Now, there are reports they might taper slowly, starting maybe April 2026, which is seen as dovish, bad for the yen.
Okay.
But Governor Ueda has also said they could raise rates if needed. So you have this hawkish hold possibility, too, if they suddenly announce aggressive tapering.
What happens then?
Well, Japanese bond yields would jump, and that could trigger a violent unwinding of those carry trades. Everyone rushing to buy back yen. That means sharp yen strength.
Wow, okay. So a lot riding on these central bank decisions. But it's not just policy, right? The analysis mentioned the geopolitical climate and market mood.
Absolutely not. That mood is a huge factor. Like we said, there's been this definite shift towards risk on in the last day or two.
Driven by the Middle East reports.
Primarily, yes. That Wall Street Journal report suggesting Iran wants to de-escalate. The market reaction was textbook, stocks up, oil down, safe havens like the dollar and yen under pressure.
That classic inverse relationship.
Right. But again, the word is fragile. It's based on whispers, diplomatic signals. Any negative headline could flip that sentiment instantly.
So it's a factor, but maybe not the main driver right now.
Geopolitical news is sporadic but impactful.
Yeah.
But the scheduled FOMC meeting, that's almost certainly the main event for the U.S. dollar in the immediate term.
Okay, so pulling it all together, what does this mean for you watching the markets day to day? Let's get practical. The high impact economic calendar,
Hmm.
the key moments, the volatility triggers.
Yeah, the next 24 to 48 hours are definitely packed. First up, Tuesday, June 17th, 8:30 a.m. Eastern Time, we get U.S. retail sales for the month. Really critical read on consumer spending.
The US consumer, always key.
If it shows a contraction like the forecast suggests, that supports Fed cuts and likely weighs on the dollar. Pretty strong number. Could see the dollar jump.
Okay, Tuesday morning, what else?
Later that day, roughly 11:00 p.m. Eastern, on Tuesday, June 17th, we get the Bank of Japan interest rate decision and press conference. Again, focus on the JGB purchase plans.
Got it. Boj late Tuesday?
Then the big one. Yeah. Wednesday, June 18th, 2:00 p.m. Eastern. That's the U.S. FOMC statement and their economic projections.
The main event.
Absolutely. The language they use on inflation, on growth, and especially that dot plot that gives us the clearest signal on the Fed's path.
And Powell speaks right after.
Yep, Wednesday, 2:00 p.m. Eastern, the FOMC press conference. How Powell frames things, his answers to questions, that will massively shape how the market reacts.
Okay, Wednesday afternoon is huge. Anything else just beyond this window?
Yeah, for anyone watching the British pound, keep an eye out for UK CPI inflation data year over year. If inflation there stays stubbornly high, sticky, it could push back expectations for Bank of England rate cuts, potentially supporting the pound.
Good to know. Okay, let's zoom in now. Specific currency pairs. How does all this global stuff actually play out? Fundamentals, technicals, sentiment. Let's start with Euro U days. The analysis calls it the epicenter of policy divergence.
Right. Projected trend is sideways to mildly bullish, awaiting FOMC catalyst.
Hmm.
The key thing, as the name suggests, is that clash. Dovish ECB versus a potentially hawkish Fed.
But you mentioned sentiment earlier.
Yes, and the sentiment picture for EURUD is fascinating. It's a really powerful signal, potentially. Large speculators, the big institutions, they've actually flipped net long on euro futures. First time in 21 weeks.
Net long, so they're betting on the euro going up.
Exactly. And it wasn't gradual. It was driven by aggressive short covering, meaning people who were betting against the euro quickly closed those bets.
Interesting. What about smaller traders?
That's the contrast. Retail traders are heavily short the euro. About 67% are selling.
Wow, institutions buying, retail selling?
It's a classic setup. The analysis calls it a contrarian setup and points to squeeze risk. If the euro does start moving up, maybe on a dovish Fed signal, all those retail shorts could be forced to buy back quickly, pushing the price up even faster. Smart money versus dumb money, as some traders call it, though that's a bit harsh.
A potential squeeze? What about the charts?
Technically, it's been stuck between support around 1.150 and resistance near 1.1630. It's also hanging around these things called institutional fair value gaps, basically price levels, where institutions might look to trade later. They act like magnets.
So a dovish Fed could really light a fire under this potential euro squeeze. That could be dramatic.
It absolutely could.
Okay, next pair. GBP USD or cable. Projected trend. Sideways to mildly bearish. Seems it's facing some headwinds.
Yeah, the cable's at a tricky spot technically. There was a bullish trend, but it's being seriously challenged by weak UK economic data. GDP shrank unexpectedly, payrolls fell. Not great news.
Right, the weak data. How's the sentiment here?
It's different from the euro. Institutions are actually firmly bullish net long GBP futures. But retail is more balanced, though slightly leaning against the institutions with 57% long.
So institutions are long, retail is mostly long too.
Which is interesting because recently, when retail got very long cable, it often preceded price drops. The analysis suggests retail might be buying into tops again.
Ah, getting caught at the peak.
Possibly. And it makes that institutional long position look vulnerable. More bad UK data or a dovish hint from the Bank of England could see those longs unwind fast. A cascade of selling.
Vulnerable longs. And technically.
It's pushing up against significant resistance between 1.36601 and 1.3644 right now.
Okay.
It is. It's caught in a tug-of-war. You have the wide interest rate gap favoring the U.S. dollar, pulling it up, but you also have the general risk-on mood, which tends to push the safe haven yen down, meaning USDJPY up, but also can weaken the dollar itself sometimes. It's complicated.
But the squeeze risk, what's driving that?
Sentiment. It's the most extreme here. Non-commercial speculators, the big players, have a massive net long position in yen futures. We're talking 184,195 long contracts versus only 39,600 short. It's an incredibly crowded bet against USDJPY rising further or for yen strength.
Everyone's on one side of the boat.
Pretty much. Few new sellers left. Right. And critically, stop-loss orders from all those getting against the USD-JPY rally are clustered just above key resistance levels. It creates a really unstable setup.
So what could trigger it?
A hawkish surprise from the Fed. Or maybe a surprisingly dovish Bojay. Either could kick off a short squeeze, a rapid self-feeding cycle of buying, as all those betting against USD-JPY are forced out, leading to a powerful rally.
A violent move upwards. Technically, where is it?
Pinned in a tight range. Resistance 145.00 to 145.60. Support around 144.00.
So a big move feels likely, one way or the other. That's a key one to watch for fireworks.
Definitely high potential for volatility there.
All right, let's look at the IU-USD, the Aussie dollar. Projected, cautiously bullish. It's a risk proxy, right?
Exactly. The Aussie is classic risk-sensitive, commodity-linked. It benefits from the current risk-on mood, and also its ties to China's economy play a role.
Okay, so benefiting from optimism, sentiment.
Here's another conflict. Institutions are actually significant net short the Aussie dollar. They're betting against it. Meanwhile, 67% of retail traders are long.
Opposite again, institution short, retail long.
Yes, so you have institutional positioning pointing down, and you have that contrarian signal where heavy retail longs often precede a fall. Both suggest potential downside, creating a real headwind against the bullish technicals and the risk-on mood. Caution is warranted.
A conflicting picture. Where is it technically?
It's pushing right up against key resistance around 0.6550, and that level also happens to be a 61.8% Fibonacci retracement level.
Ah, the Fibonacci level, a key
Exactly.
technical spot traders watch.
Precisely. Often a point where trends stall or reverse.
Okay, next. USD CAD, the loonie. Projected, bearish. It's tied to oil, isn't it?
It is, yeah. Canada is a major commodity producer. So the recent drop in WTI oil prices, linked to those Middle East de-escalation hopes, is fundamentally negative for the Canadian dollar, the loonie.
But the forecast is bearish for USD CAD, meaning CAD strength.
Right, because that negative from oil is currently being more than offset by the general pervasive weakness we're seeing in the U.S. dollar itself.
I see. So USD weakness is the bigger factor right now. What about positioning?
Similar extreme setup again. Institutional speculators are extremely bearish on the Canadian dollar, meaning they're very bullish on USD CAD.
So they're betting on USD CAD going up despite the current trend.
Correct. And like with USD JPY, the analysis warns this is a crowded trade, vulnerable to a squeeze down if the US dollar weakness continues, but potentially ready to rally hard if we get a hawkish Fed surprise that unwinds those CAD shorts.
Another crowded trade, another squeeze risk, technically.
It's trading below key resistance at 1.3750, and momentum looks bearish for now.
Okay, last pair. USD CHF, the Swiss franc, projected. Sideways to bearish. Two safe havens.
Exactly. Both the US dollar and the Swiss franc are traditional safe havens. So the current risk-on mood is generally negative for both.
So how does the pair move?
It comes down to relative weakness.
Right.
Which one is the market selling more aggressively? Right now, the analysis suggests it's the US dollar taking the bigger hit, hence the bearish lean for USD CHF.
Makes sense. And the sentiment here?
Institutions are heavily bearish on the Swiss franc itself. That implies they have a bullish bias for the USD CHF pair.
Wait, institutions are betting on USD CHF going up, but the price is going down.
Precisely. The positioning is at odds with the current price action. This divergence creates, yet again, a risk of a short squeeze or rally in USD CHF if something boosts the US dollar, like that hawkish Fed scenario.
Lots of potential for positioning unwinds. Where is it technically?
It's been in a steady decline, approaching key support down around 0.81 euro nil.
Fascinating how these sentiment readings clash with price action sometimes. It really shows how interconnected everything is. The analysis mentions these intermarket relationships too.
Absolutely crucial point. Nothing moves in a vacuum, especially not Forex. Take the US dollar index, DXY, and the S&P 500. Right now, classic negative correlation. Risk on lifts stocks, pushes the DXY down. If that reverses, maybe on Fed news, you'd likely see stocks fall and the DXY rally.
Okay, DXY and stocks moving opposite.
Then you have the commodity currencies, AUD, CAD, and WTI crude oil. That oil price drop we mentioned. Direct headwind for the CAD. If tensions flared up again, oil would likely spike, potentially supporting the CAD.
Oil and the loonie. Got it.
And finally, gold, XOUSD versus real yields. Gold's been strong, partly due to geopolitical risk, partly due to falling U.S. Treasury yields. But if a hawkish Fed pushes real yields, that's yields adjusted for inflation higher, that makes non-yielding gold less attractive. Could see a sharp gold correction.
So watching yields for gold's direction, this all highlights how many moving parts there are. Which brings us to the big question. What are the main risks that could just blow these forecasts out of the water?
Yeah, the analysis flags three primary risks that could completely change the picture. Number one, the biggest one, the FOMC hawkish surprise. Keep coming back to this. The market's leaning dovish. If the Fed pushes back hard, signals fewer cuts, or even hints at hikes, expect fireworks.
What kind of
A
fireworks?
likely violent repricing across all asset classes. Sharp US dollar rally, equities probably drop hard, a big risk-off move. That would kill the bullish forecast for USD, audio USD, and very
Yep.
likely ignite that big USD JPY short squeeze.
Okay, Fed hawkishness is risk number one.
Number two, geopolitical re-escalation. We talked about the fragile sentiment. Any sudden and negative development in the Middle East, talks breaking down, a major incident could trigger an immediate flight to safety.
Name.
Surge in demand for USD, JPY, CHF. Risk currencies like AUD, NZD, even EUR and GBP would get hammered. It would be fast and potentially messy.
Right, geopolitics can turn on a dime. And the third risk.
The BOJ, hawkish surprise. Less likely maybe, but still significant.
Yeah.
If the Bank of Japan suddenly announced a much faster reduction in their bond purchases or used surprisingly hawkish language about future rate hikes.
The yen would strengthen.
Dramatically. It would be a powerful bullish catalyst for the yen, triggering that rapid unwind of carry trades we discussed. That would ripple through almost all major pairs involving the yen.
Okay, three major risks to watch: Fed, geopolitics, BOJ. So wrapping this deep dive up, it really feels like the next 24, 48 hours are incredibly important, a real inflection point.
Absolutely. And the key takeaway, I think, is understanding how these things connect. The central bank divergence, that fragile market mood, and crucially, those extreme speculative positions we saw in pairs like USD JPY and USD CAN.
That crowded trade idea.
Exactly. Markets often find ways to move against the most crowded positions, especially when fundamentals start shifting underneath them. Being aware of where the crowd is positioned is vital.
And this isn't just abstract market stuff, is it? It connects back to the real world.
Yeah, it's about the forces moving global capital, influencing trade, inflation, the cost of borrowing. It touches almost everything. So maybe a final thought to leave you with. If the so-called smart money is positioning for potential squeezes, actively betting against these extreme positions in some pairs, what does that tell you about the underlying stability or maybe instability of the market's current assumptions?
Mm.
And how quickly could those assumptions be completely shattered by what the Fed or the BOJ does next? Thinking about those dynamics helps you move beyond just reacting and maybe start anticipating what could come next.